The history of accounting or accountancy is thousands of years old and can be dated back to ancient civilizations. The early development of accounting was closely related to developments in writing, counting, and money. There is proof that an important measure in the development of counting was tied to the early development of accounting and money which took place in Mesopotamia.
Luca Pacioli, recognized as the father of accounting and bookkeeping, was the first person to publish a work on double-entry bookkeeping and introduced the field of accounting to Europe. During the Roman Empire, in the time of Emperor Augustus, the Roman government had access to detailed financial information. Further development occurred during the medieval and Renaissance periods, such as double-entry bookkeeping. This happened in the 13th century when merchants relied on bookkeeping to keep track of multiple transactions. Bookkeeping is defined as any bookkeeping system in which there is a debit and credit entry for each transaction. The development of joint stock companies built a bigger audience for accounting information, as investors without direct knowledge of their operations relied on accounts to provide the needed information. The modern profession of chartered accountant originated in Scotland in the 19th century. During this time, accountants often belonged to the same associations of solicitors, and the latter solicitors sometimes offered accounting services to their clients. All these events eventually led up to what we know now as accounting.
Now, let's move on to the functions of accounting. The first is financial reporting. The key output of any accounting department is a financial statement. Whether public or private, all companies need to prepare and issue financial statements. These will include the income statement, balance sheet, cash flow statement, and statement of retaining earnings. The next is management reporting. The metric used for this type of reporting vary depending on the size of the business and the industry it is in. Third, internal auditing is primarily concerned with whether there are controls in place in the financial reporting process, and if correct procedures have been followed to enable accurate and timely financial statements. Next up is financial operational risk, analyst manager. In business, where accounting software plays a big role in the financial reporting process, there is often a need to identify and manage the risks involved in the day-to-day operation of these computerized accounting systems. The last is accounting information systems. When dealing with computerized accounting systems, the accountant becomes a link between management and IT developers, as he or she translates management needs the requirements that the IT department can understand.
Next, we will discuss the types of businesses as to source of income. First is service business. A service type of business provides intangible products. Tangible products are products with no physical form. Service type firms offer professional skills, expertise, advice, and other similar products. Some examples of this service are schools, repair shops, hair salons, banks, accounting firms, and law firms. Second is merchandising business. This type of business buys products at wholesale price and sells the same at retail price. They are known as buy and sell businesses. They make profit by selling the products at prices higher than their purchase costs. A merchandising business sells a product without changing its form. Examples are grocery stores, convenience stores, distributors, and other resellers. Third is manufacturing business. Unlike a merchandising business, a manufacturing business buys products with the intention of using them as materials in making a new product. Thus, there is a transformation of products purchased. A manufacturing business combines raw materials, labor, and factory overhead in its production process. The manufactured goods will then be sold to customers. Lastly, hybrid businesses are companies that may be classified in more than one type of business. A restaurant, for example, combines ingredients in making a fine meal, which is classified as manufacturing, and it sells a cold bottle of wine, which is merchandising and fills customer orders or service. Lastly, we will be discussing the three types of ownership. A sole proprietorship is a business owned and operated by a single individual. The advantages with a sole proprietorship include ease and cost of formation, simply announcing you are in business and requesting any licenses and permits you may need, or use of profits. Since all profits from the business belong exclusively to you, the owner, flexibility and control, you make all the decisions and direct the entire business operation. Very little government regulations, secrecy, and ease of ending the business.
A partnership is a business that is owned and operated by two or more people. There are two basic forms of partnership, general and limited. In a general partnership, all partners have unlimited liability. While in limited partnership, at least one partner has liability limited only to his or her investment, while at least one other partner has full liability.